Recently, there's been a lot of uncertainty surrounding the stock market because of tariff threats, uncertain leadership, companies not delivering on their earnings, especially as we've seen in the news, some Chinese AI companies are delivering the same results as maybe a Microsoft or an Apple with 95% less cost. These concerns have reignited fears of a bear market, and I think it's important to understand what a bear market is, if we're actually in one, and more importantly, how you can take advantage of a bear market for your stock portfolio. And that is exactly what we'll be covering in this video. Before digging deeper into how you can take advantage of a bear market, it's first important to understand what a bear market is and how it's different from a recession and a market correction. A bear market usually lasts 9 to 18 months and is usually a 20% or more decline from the highs of the stock market. For example, if the S&P 500 is currently at 610 and it falls to 20% below that, we would officially be in a bear market. This is different from a market correction where the stock index falls 10 to 19% but ultimately recovers after 3 to 4 months. Corrections are usually short term, and if you look at the yearly chart, the stock index is usually on an uptrend. Bear markets are also different from stock market crashes. Crashes occur when the stock market goes down 30% or more in a very short period of time. For example, the 2008 financial crisis led to a sudden drop in stock prices. A gradual decline that is not that steep does not account for a market crash and is nothing to be concerned of. Given this data, we're not currently in a bear market since stock indices are at all-time highs or close to it. We might be in a market correction phase where in the next 3 or 4 months, we see a slight correction. Now that we've distinguished between a bear market, a recession, and also a market correction, it's important to understand why bear markets occur in the first place. The number one source is economic data and trends. Inflation is a big indicator that leads to a future bear market. For example, in 2022, when inflation was at an all-time high in recent years, the stock market gurus predicted that the Federal Reserve is going to raise interest rates, and because of that future prediction, stock indices saw a decline in price. Slowing GDP growth is another indicator where, for example, the country doesn't deliver on economic output, and this happened in 2008 where the US GDP shrunk by 4.3%. Another major indicator is unemployment. If the unemployment indicator is increasing, that means that businesses are not hiring enough, leading to a slowdown in economic growth. These are all good though, but they're usually indicators that occur when the bear market has already happened. How do you spot a bear market or signs of a bear market before it occurs? We have the volatility index or the fear gauge. Higher levels suggest extreme investor uncertainty and is an indicator used by a lot of analysts to predict or analyze if we're actually in a bear market. But there's one concept that a lot of analysts use to predict whether we're in a bear market or not, and that is the market cycle. The market pretty much is divided into 4 main stages. The first is the expansion or boom stage. This is where there's high economic growth, businesses are expanding, earnings are getting beat left, right, and center, and companies are employing more people. Overall, there's a very euphoric feel in the stock market. This could be because of the Federal Reserve's policies or other indicators worldwide. A recent example is the 2010-2019 bull market, where every single year, the S&P 500 and the Nasdaq 100 beat its previous record highs. This expansion ultimately leads to a peak. This peak is at the highest of the highs. Everybody is euphoric, everybody is Warren Buffett, everybody thinks they're a good investor. And this is where the bursting of the bubble happens, leading to a bear market. A recent example is the 2020 crash, where stock indices lost around 30% in their value, leading to a huge opportunity for investors to jump in. This is where most smart investors get into the market, when there's a correction. Of course, buying at all-time highs is also okay if you look at the long-term potential of the US stock market, but if you're able to buy in a market correction, that is where you make your actual money. That is where you make real potential gains. Because the fourth phase after this contraction is the recovery or the boom again. This is because of policies that the government implements, maybe a cut in interest rates, quantitative easing, decreasing tax rates, whatever it may be. The government wants the stock market to do well because that is how individuals create wealth. And if you can partake in this phase before the boom actually happens, you might see reasonable gains in your portfolio. If you look at the 2020 crash, investors that bought at a 40% discount saw tremendous gains. Even the crash in 2022, investors that have bought in 2023 have seen massive gains in the next 2 years. If you want to magnify your gains further, you might want to pick stocks that are beaten down severely. For example, Meta Platforms in the 2022 crash. The PE ratio was under 12, meaning that investors saw that Meta has nowhere to go, nowhere to expand their profit margins or their earnings, which in fact we all know is just a temporary market sentiment. That's one side of the coin where you want to target companies like Meta and other tech companies that might be at a discount in the long run. Of course, you can just buy an ETF and forget about all of this, but just in case you want to take some risk in your portfolio with that 5-10% fund money that you might have, you might want to look at companies with a beaten down PE ratio but high growth potential. The other side is buying companies that are defensive so that you can protect your wealth in the short run. For example, companies like P&G, Pepsi, and other consumer defensive goods tend to fare better in a bear market. This is because everybody needs toilet paper. This is because everybody needs a Coke, especially Diet Coke. It's very, very good. No matter if you're in a boom cycle or a bust cycle, you can combine both of these investment opportunities to get a decent return on your portfolio. Another type of company that people like to buy in bear markets are dividend aristocrats. Dividends give you a percentage of return on your stock no matter what the market cycle is. If Coke, for example, pays 2.5% in dividends, you're gonna get that 2.5% no matter if you're in a boom cycle or a bust cycle. So you might want to take part in some of these dividend aristocrats just for the sanity of your own mind. The key point is to actually partake in the stock market when there's a bear market. Historically, bear markets last 9 to 18 months, whereas bull markets last 5 to 6 years. If you look at it in terms of your entire lifespan, if you get a bear market, it is a good opportunity to get into the market in the first place, because in high probability, you're not gonna see the same buying opportunity 4 or 5 years from that current point in time. Given the long-term return of the S&P 500 and the Nasdaq 100, with the S&P 500 in particular returning 10% on average for 40 and 50 years now, you just don't want to pass up a bear market opportunity. No matter what I say though, bear markets are an emotional time. People are fearful of losing their money because we work really hard to earn money. Money is not easy to make in this world. To see your money evaporate and that chart go down, it is a sad feeling, but this is where I use a concept called dollar cost averaging. I don't lump sum my money into the market if I don't feel like I'm gonna get a good return, especially in bear markets, because it is human nature. It is just natural for me to believe that if the stock market price is going down, I better not invest my money. Dollar cost averaging helps me negate this fear. If I have $1,000 to invest in a month, I'm gonna invest $500 in this month and then wait for the next month to invest $500 plus extra money that I get for that month. This way I'm investing a lesser amount every single month and averaging my way into the market. Instead of lump summing tens of thousands of dollars into the market, which for me is a huge amount, investing lesser amounts in the market keeps my mind at peace. And it ensures that in this 9 to 18 month cycle of the bear market, I'm still able to participate. Of course, the bear market might be longer, it might be shorter. I just want to make sure that I participate because this is where the real gains actually are. Another strategy that helps me is having money for an emergency fund. I don't YOLO all of my money into the stock market. I have 6 to 7 months of expenses saved and kept in a high yield savings account. This is accessible by me any time that I want to and ensures that even if, for example, there's a long-term bear market and I'm not able to invest more, no matter what happens, I have 6 to 7 months of expenses saved and kept aside. I don't touch this money. I don't put it in the stock market. I don't put it in any investments. This is my money that is my fail-safe. If everything else fails, even if my stock portfolio goes to zero, I'll still have the 6 to 7 months of expenses that I can rely on and withdraw on in case that I need money. Now that's what you should be doing in a bear market. What should you not be doing? You should not be chasing high growth stocks that have no profitability. This is what a lot of people did after the 2021 and 2022 crash. They chased a lot of high growth stocks, particularly tech stocks that had no profitability and no future growth potential. In a bull market, as with all bull markets, some companies see a very high increase in valuation for no good reason. You don't want to be chasing companies that are not good companies fundamentally. A lot of tech companies had high valuations. They crashed 70% just like Meta, but were not able to recover because they're not profitable. They don't have future growth potential. They don't have a good business model. You want to be looking at companies and you want to be looking at ETFs that contain companies with profitable, solid business models that are going to be profitable in the future, not just now. Another thing that is tied into this is do not chase penny stocks for a dead cat bounce. A dead cat bounce is essentially when the stock is decimated down 80-90% and you're looking for that 10 to 20% recovery. That in all likelihood is not going to happen. Buy quality companies and quality ETFs in a bear market and almost guaranteed probabilistically in the long run, you are going to make money. Now that you know what to do and what not to do, when do you actually know that the bear market is over? The biggest sign is change in policy. Because of high inflation in 2022, the Federal Reserve started raising interest rates to a level we've not seen since the 2008 financial crisis. They got inflation under control and started cutting rates. That is when you know the bear market is heading towards its closure. since a decrease in interest rates means that it's easier to borrow and easier for companies to expand. Another big indicator is earnings reports. If companies are consistently beating earnings and smashing their revenue targets, it probably means that business is good and GDP output is going to be good for that particular country. If you look at the United States, companies like Apple, Google, Microsoft, big tech companies and manufacturing companies as well have been consistently beating earnings and smashing revenue estimates. This is how you know that we're probably not in a bear market, since companies are continuing to expand and increase their revenues. And the volatility index that I talked about, if VIX is down, that basically means that investors are confident in the state of the stock market, they're confident in the state of future policies related to the stock market, and confident in the bigger companies to deliver earnings. Given all these three indicators, you might conclude that we're actually not in a bear market, which is true, but we might be right at the bubble. The good thing is, now you know if it falls, it's a good opportunity to buy. Even if it increases, realistically, buying at the top is also probabilistically going to make you money in the long run. Remember to partake in the stock market, whether it's a bull market or a bear market, and you'll thank your younger self 20 years from now. I hope you enjoyed this, and I'll see you in the next one.